Welcome back. Falling oil prices and the changing implications for global producers was the topic of recent debate here in Washington. VOA's Carolyn Turner has more in part one of our two-part series on oil prices.
Over the last 8 months, there has been a dramatic decline in the price of oil worldwide. In June of 2014, Brent topped $110 a barrel. Now it is just under $50. As the price of oil continues to fall, the Wilson Center convened an expert global panel in Washington to discuss the economic and political repercussions of depressed energy prices. Analysts believe OPEC and Saudi Arabia are driving the price of oil down to drive out U.S. oil frackers. Fracking is the procedure of extracting oil and gas out of rock.
It's important to understand that OPEC or Saudi Arabia leading that effort is trying to regain market share, to establish itself as the dominant producer. We heard earlier that the U.S. in 2014 was the biggest oil and gas liquid producer. Essentially, in a different language, you can say the real swing producer of the world is the United States now. It's not Saudi Arabia anymore. And that is a major strategic and geostrategic shift that we have to take into account.
With the development of fracking in America, the world's oil supply has increased beyond demand. But so far, fracking is not profitable in the U.S. when oil drops below $40 a barrel. Once the frackers stop drilling, the oversupply is expected to decline and prices are expected to normalize above $60 a barrel, a profitable price to pump oil in the U.S. Until supply contracts, oil prices will languish and countries that export will continue to suffer from weak revenues. Oil's price decline has created dramatic consequences throughout the world. In Canada, it is still profitable to pump oil as low as $48 a barrel, but oil revenues will bring in $8 billion less this year to the Canadian economy. Colombia's oil revenues needed for infrastructure and education have been cut in half, and the Colombian peso has weakened.
It is estimated that $1 decline in price has a $200 million impact on fiscal revenues.
Oil revenue brings in 8 to 10% of Mexico's economy, which has suffered. But even if oil goes as low as $23 a barrel, pumping would continue and oil would be stockpiled. Some Middle Eastern countries like United Arab Emirates, Saudi Arabia, and Qatar have huge reserves and can survive a price drop. Iran, Iraq, and Bahrain are in poor economic positions and are suffering from the price drop. Africa's importing countries are benefiting from the drop in oil, while exporting countries have suffered losses to revenues. Several OPEC nations like Venezuela, Libya, and Nigeria are so reliant upon oil revenues, they face domestic unrest if they try to cut production.
Some countries that are not producing, low oil is good news. For those of us who are producing and relying on it, low oil is not that good news. And for countries such as Nigeria, which is in the peculiar position of being a major global producer and exporter and also a major importer of products, it feels the pinch both sides, high oil prices and low oil prices.
Oil markets could be in for a bumpy ride. OPEC decisions shape the oil market. If it cuts supply sharply, oil prices could spike. But Saudi Arabia, which produces 1/3 of OPEC oil, refuses to cut production. Demand is low because of weak economic activity and the trend away from fossil fuels. Carolyn Turner, VOA News.
Well, tomorrow on Africa 54, we'll have part two of Carolyn Turner's report on oil prices, so be sure to join us.